Coming into the second quarter of 2024, what we see is a favorable investment environment for both bonds and equities. As inflation continues to be on a downward trend in the US, we hold a view that the Fed will start cutting rates in June, followed closely by other major central banks in developed markets. Markets always try to anticipate those cuts, and we think that they are quite realistic on this front. The other piece of good news is that the resilience of US growth, which has kept the global economy out of recession. So what does it mean for investors? Our investment themes for the first quarter have actually been working well, and we therefore largely stick with them. So let's take a look. Bonds play a crucial role in portfolios for diversification and income generation, and they tend to perform well ahead of the first rate cut. As real yields are too high to sustain, they are likely to come down in coming months. So locking in current bond yields now is the right thing to do, and this can be done by extending bond duration. We continue to focus on quality bonds for their better risk-adjusted returns, and that means US Treasuries or other government bonds up to 10 years and investment-grade credit for 5 to 7 years maturities, particularly in US dollars. And in Asia, we like selected banks, Indonesian quasi-sovereigns, and Chinese IT, media, and telecom. We also like Indian local currency bonds for their diversification and yield enhancement. We've become more positive on global equities because of three key drivers: better than expected economic growth, strong earnings power, and favorable rate outlook across regions. In the West, the US stands out on all of these fronts. What's more, US equities have historically performed well before the first rate cut and in an election year. And these positive catalysts support us in adding to US equities. Asia remains a growth engine, and we continue to diversify into the region by focusing on the growth leaders in India, ASEAN, particularly Indonesia, and South Korea. Japan has recently been added to our overweight list due to its reflation trend, improved corporate governance, and the AI investment boom. Cyclical and structural trends are translating into long-term opportunities beyond technology. In the US, strong labor markets and real wage growth should continue to boost consumption. And there is a huge deal of innovation in technology and healthcare, and the re-onshoring process is boosting manufacturing activity. Now, all of this supports the outlook for stocks in the industrials, communications, financials, and healthcare sectors. European markets will probably continue to trail the US, but we see pockets of opportunity in financials, healthcare, and energy. Now, in Asia, we believe the consumption story driven by rising private wealth and strong domestic spending power remains compelling. E-commerce and semiconductor manufacturing leaders should also benefit from these global trends. Sustainable investing continues to see steady growth as tackling climate change gets ever more urgent. The broadening of sustainable solutions and improved regulatory frameworks are creating interesting investment opportunities. Rate cuts will help lower the cost for companies to invest in renewable energy such as solar, wind, biofuels, and hydrogen, as well as innovative technologies to reduce carbon footprints. Companies that are at the forefront of preserving biodiversity, which is also gaining traction globally, should also benefit in a similar fashion. So in conclusion, we see a wide range of opportunities on the horizon, but of course, the data flow remains volatile and geopolitical risks are not going away. So a diversified approach with a focus on quality, therefore, remains our top tip to our customers. And as always, we're here to help you incorporate these themes into your portfolio.